So they'll find ways of surviving as well. And as Manoj was mentioning, at the end of the day, capital will chase returns.
So my question is to Dr. Manoj Shenoy. So the question is, as you said, that 32% of the GDP is in savings, and of this 70% goes into the debt markets. Suppose if 70% goes into the capital markets, so would India be able to survive the subprime crisis? And are the Indian capital markets really so efficient like US so that they could survive the 2008 subprime crisis?
See, one is we need a lot of supply. See, today, as I said in the beginning, our capital markets are little shallow, and very, very limited percentage of the money gets into the capital markets. Now, if you look at it, the main reason is that you also need supply to increase, people from investing. You are having 6,000 companies, but I think we have one of the largest number of listed companies in the world in the Bombay Stock Exchange, but most of them are marginal companies. So there are no global scale large companies like if you look at it, if you look at the top 50 banks globally, not one Indian bank is there. And to also go one step ahead, like what Gurudas was talking about, outbound acquisitions. We don't have, none of the banks, Indian banks, have a balance sheet size to take on that big deals, like a 6 billion Novalis deal or a 11 billion Chorus deal or something like that. So I don't think, if at all anybody have benefited in terms of this one, it's only the foreign banks who have benefited because of the balance sheets what they have. So technically speaking, even including the State Bank, which is number one in the country, it is not even in the top 50. So we need large amount of supply in terms of papers for people to buy in, and large IPOs to also come in, and that will broad base the whole thing. Till such time, it is going to be a chicken and egg story, and so and I think the way things are going, we need everything at global size, including, I think I was talking to people in the State Bank of India. They will get into top 50 if they merge all their subsidiaries with them. Now they are not able to do that because if they merge State Bank of Mysore, people in Karnataka will object. If they merge State Bank of Jaipur, Bikaner or Hyderabad, so you have problems in that state. So unless they do that, unless we have fairly large financial, banks with the large, this one, they will not be able to participate. It's basically the foreign banks which are actually taking benefit of the whole thing. Yes, I think we need to see a lot more supply, larger supply in terms of.
My question is to Mr. Ramakrishnan. As you see, every sector is trying to concentrate on the bottom of the pyramid, like say FMCG or say automobile. So do you think that Indian capital market should concentrate on the bottom of the pyramid, and would they able to include all the people in the bottom of the pyramid, and will it ever be possible for India capital markets to be included, to include the bottom of the pyramid?
As in am I audible? Yeah. We touched upon it in our session. See, we can talk about greater involvement and greater participation of retail investors. So, as in, we can endlessly talk about it, but see what's happening on the ground. The ground realities are something which we got to face. One, in terms of what came up earlier, the percentage of household savings which is going into capital markets. So as we were talking earlier in our session, in fact, we've seen a downward trend, right? So earlier in 91, 92, it was almost close to around 14% of household savings which used to go in. But the size of the capital markets was small then. So as in it's a significant percentage, but you got to look at the absolute value too. But today, if you look at it, if we are at say 7 to 8% of savings going, as in we have a long way to go. And as in what we continue to talk about is exploring various distribution models, right? As in who will do the last mile connectivity. Now, as an aside, we were also discussing about the business correspondent, just the banking industry per se. Let's leave capital markets for the time being. As in talking about financial inclusion, etc. As an RBI has come up with this mandate to facilitate greater inclusion. So even in the mandate for the new banking licenses which they've come up with, as in one of the parameters which they've clearly highlighted in the draft guideline is around 25% of the branches have to be in rural areas. And if it's an existing NBFC and if it wants to convert itself into a bank, as in obviously there are certain structural changes which they need to adhere to in terms of having a non-operative holding company and limited interest in brokerage, real estate, construction, wherein there can be speculation. So leaving those aside, now 25% in rural branches, but the flip side is, so this is on one side, as in regulators are pushing, trying to push financial inclusion. But if you look at the flip side of the same draft guideline, the regulator wants these newer banks to list within 2 years of operations. So, as in how can the bank become, say, profitable and make itself attractive to potential investors when it's going to put in a significant chunk of investment in certain regions and in certain branches where they might not make money immediately or probably even in the medium term. So, as in all these, all these attempts can be looked at from either angles, and it's not going to be an easy journey. So, as in having less than 25 million, account holders participating directly or indirectly is as in we are still in infancy stage. We have a long way to go in terms of greater retail participation in fact, just to quote another example, in one of the mutual fund summits which we had presented, so a significant fact which came forth from the head of HDFC Asset Management was, he said, almost 80% of our assets in management come from the top 8 cities in India and come from the top retail investors in these top 8 cities in India. So as in, where is the talk of Tier 4, Tier 5, Tier 6 rural centers? So we have a long way to go in terms of getting these innovative models, distribution models on the ground. How do we involve, say, the players who can get the last mile connectivity, be in terms of post offices, mom and pop stores, telcos, the stores which deal with telco cards and FMCG players. So how can we involve those together, and business correspondents, of course. So and it's a lot of it is being spoken about right now, but I believe it will take significantly longer time for us to see the benefits.
Okay. I think with that we will close this panel discussion. Since we had a panel of speakers with a very broad range of experience and skill sets, the discussion was, I'm sure you will also agree, that it was really nice, and it must have been come as an eye-opener to many of you. So I'd like to thank the speakers who have come away from their busy schedules, to be with us today. So please give them a big hand.
It was indeed a very enriching discussion with varied views on the importance and role of capital markets. how each factor has its influence, how we need to cruise ahead in the face of the current challenging situation, and most importantly, what lies ahead. I would like to thank all the panelists and the moderator for the intense and insightful discussion. Thank you, everyone.